Gland Pharma is a unique play on the expanding domain of generic injectables. So far, its strong CDMO platform and impeccable regulatory compliance history have helped the company gain leading market share in some of the generic injectables. However, the rising competitive intensity, one needs to track how the company forays into complex injectables. In FY22, the company added 4 new production lines at the sterile injectable facility at Pasha Mailaram, thereby enhancing formulation capacity by 25%. New lines would help the company develop complex injectables pipeline for suspensions, hormones and emulsions-based products. Another area Gland Pharma is looking at is partnerships to accelerate entry into the biologics CDMO market. Now, the company plans to leverage the strong know-how in biologics development and manufacturing of its parent Fosun Pharma Group. About 80+ biological drugs are going to lose exclusivity in the US and EU over 2021 to 2025. In this context, repurpose of vaccine facility for biologics would be keenly watched. Furthermore, in the next 2 years, it has a capex plan of 550 crores aimed at strengthening portfolio of complex injectables, increased capacity of enoxaparin, expansion of warehouse capability and APIs. It also plans to acquire advanced stage assets of complex injectables and APIs in the fermentation value chain. The company has a robust net cash position and cash flow from operations, which can help inorganic expansion and capital expenditure requirement. Now coming to the recent performance, Q4 FY22 sales growth of 24% YOY was backed by a 32% growth in the rest of the world and 137% growth in domestic market. The core markets of US, Europe, Canada and Australia, which constitute 67% of sales, grew 8%. Here the growth rate was lower than usual because of shortage of syringes. EBITDA margins were impacted due to change in geographical mix, higher logistics and utilities cost. Near-term headwind for the company is the shortage of syringes, tubing, filters, vials and stoppers, which can continue till Q2 of FY23. Now, this is weighing on the near-term growth trajectory for the US market. Having said that, launch pipeline remains steady as the company plans to launch about 24 molecules in the first 3 quarters of FY23. Another aspect to watch is the changing product mix as COVID-related demand has started to ease. Now, the mix is expected to gradually shift towards injectables used in elective surgeries. The company still, however, sees good growth runway for enoxaparin, which is used to prevent blood clots and was in huge demand during COVID. Gland Pharma is seeking enoxaparin approvals in newer territories wherein competition is lower than in the US market. The only region the company is avoiding is Europe due to the pricing pressure and complexity of registration. It's interesting to note that the company currently has about 10% global market share in enoxaparin and is looking at China as a promising market to enter. However, this market could be contested as peers in China are already backward integrated. Foray into China remains key for other products as well. However, there has been a delay with respect to working with regulators in China. Overall, in FY23, management expects a moderation in growth due to high base effect. Higher growth is expected from the rest of the world portfolio, wherein the company continues to aim for new launches and registrations. On the EBITDA margins front, near-term guidance remains in the range of 35 to 37%. We believe margins can undershoot in the near term due to continuation of various supply-side challenges. Now coming to the valuations. Post the recent correction and downward adjustment in estimates, Gland Pharma is trading at 17x EV to EBITDA for FY24 projected earnings. This is at about a 20% discount to peers like Syngene and even Divi's labs. While in the near-term equity market looks fragile, Gland Pharma makes a cut for the longer haul. This is because of the rising prevalence of chronic diseases and growth of biologics, wherein injectables have a role in treatment and drug delivery. Our investment cause is also backed by strong regulatory compliance history, expanding complex injectables capabilities, and a supportive balance sheet.